My name is Amrata Basu, and I'm responsible for TT's initiative on training and user experience. Thank you guys so much for joining today's TT live webinar on the fundamentals of Autospreader. This is the first webinar in a series of 3 that we will be running for TT's spreader tool, Autospreader. In this webinar, we are going to discuss what spread trading is and the benefits of it. We will also explain Autospreader in detail by going through all the different configurations that users can set up. We'll end with a Q&A session. However, if you have any questions while we are going through the presentation, please feel free to send them in, and we will try to address them as we go along. And if we don't get to the questions, then we'll definitely answer them at the end. If we run out of time, we will email answers back to everyone who's participating today. Also, this webinar is being recorded, and once we have the footage ready, we will send that out to everyone who's here as well today. Today's webinar is going to be led by Mike O'Reilly, who is a training and user experience specialist here at TT. Before Mike joined TT, he was a customer using the platform. He has been with TT for approximately 10 years and has a vast knowledge of the platform, as he has worn several hats within TT. With that being said, I'm going to hand it over to Mike. Mike, all yours.
All right. Thanks, everybody, for joining. As Emery said, we're going to go through, Autospreader and the functionality and kind of the fundamentals and build out a basic spread and so forth. Before we get going, I have been battling a cold, so if I miss the mute button and I sneeze or cough, bear with me. So let's jump in here. So, we have people of all levels that are going to be joining this webinar. So, we'll start at some very basic ideas and kind of work our way through right up into executing spreads with Autospreader. So right at the beginning, why are we spread trading? And, what are we trying to express? There's always some idea that we're trying to express in the market, whether prices are going to diverge or converge. And how do we take advantage of those changes in the market that we, have this feeling for? So, the best example is typically crude WTI versus Brent, which will kind of be our example for the session today. And, if we feel that that the spread between these two, different delivery points, different contracts, different exchanges, if we feel that this spread is going to get wider, we can, buy that spread, expecting it to get wider, and then, hopefully profit from that move. In the same way, also, we can sell it in order to, capitalize on, convergence of those prices. So also, if we think back about 9 months ago, crude oil was, up or down $3-4, given the geopolitical situation that we were in. And, if that's too much risk, a spread can be used to, kind of reduce the risk of, of those movements, because within the spread, the movement might not be as severe, but we're still able to express that, that long or short idea, using spread trading, and in this case, in Autospreader. So, thinking specifically about Autospreader and ASE, as we say here, what kind of, what are the typical trades that we do? A lot of times it's an arbitrage trade. So, you can simultaneously buy or sell the same product that's listed at different exchanges in order to take advantage of, any kind of price discrepancy that might occur. If you're, we also, a lot of people are using it for correlated trades. So if you think about, let's say, equity indexes. So if we think about the S&P and the NASDAQ, although the moves might be bigger, if there is a idea that these two indices might, again, diverge or converge, you could formulate some kind of a ratio spread. And then as that correlation, although they both may be going in the same direction, maybe they don't go in the same direction as much, and you want to express an idea that they might diverge or converge or whatever it might be. Also, a lot of ASE trade is done using, in order to roll positions. So as a future nears its expiry, a trader might not wish to exit a trade and move their position from one to the next. So if the front month is coming due, they would be, selling out of their position in the front month and then entering into the next month. And in order to achieve a beneficial price, or to minimize their cost in rolling that position from one to the next, they might use Autospreader in order to achieve a a better price in making that roll from one to the next. Also, there's quite a bit of market making that gets done. So if you have, again, similar to the arbitrage example, where if you have one product that is traded on one exchange, and you can use that or maybe a series of products as your reference price in order to, look at another product and then quote in that product, Autospreader can be used to, view the other instruments and then price in this, in your primary market, and then you can market make based on that spread that you configure, which is kind of what we'll be doing here today. So as far as Autospreader itself, it allows the user to create, the synthetic calendar or inter-product or inter-exchange spreads. And this allows you to, take instruments from all over the TT universe, let's say, so from all the different exchanges, and then, create spreads, and again, express an opinion in the market based on, what, configuration we actually build. So when you create these synthetic spreads, every instrument is its own instrument. So crude oil comes from the CME, and that contract has its own instrument. And then, Brent comes from ICE. And when we put these together, you're creating your own synthetic instrument within TT. And this belongs to you as an individual. So when you create the synthetic spread order, Autospreader submits a quoting order in the designated quote leg or legs based on the hedge leg and the available liquidity that is offered there. Now, this will become more clear as we walk through the example, but you'll see that the quote leg is purely based on where we're able to hedge this particular order. Autospreader, we have these servers globally, so Autospreader server location is at all the exchanges in order to provide you with the fastest service so that you can get a quick requote and a quick hedge order sent, and therefore the servers are co-located at each one of these locations globally at a proximity located at the exchange matching engine. So with that, what we should be looking at a workspace somewhat blank at this point. And as I mentioned, we're going to be looking at Brent and CL, so Brent from the ICE exchange and CL from the CME, and we're going to build a simple spread that is going to encapsulate these two instruments and how we go about doing this, and why we do what we do, and kind of walk through the configuration. Okay, so if we go up to widgets and we go to automation, first option that we're going to have there is going to be Autospreader. And from here, I'm going to filter this down a little bit. Okay, so from here, this is where we have our list of instruments, okay, that we have created. Now, in this case, they are Autospreader instruments. So they are products, they are spreads that we have configured ourselves, and that we can, then go and trade in the market to, again, express our ideas about where things are going to move around. So, right from the basis, in order to create a new one, there's a create button in the upper left, and this is going to bring up our create spread window. So this is our Autospreader config. So we're going to walk through, line by line here and kind of build out the spread, and then, start to execute and kind of go back and forth and tweak some of these things so that you kind of get a sense of how to configure these sort of things. So in this case, the first thing we have to do is we're going to have to name our spread. So in this case, we'll name it MRCL BRN2. And as we go to the right here, we have a share checkbox. Now, the sharing checkbox will allow us to share this particular spread with our fellow users in our company. So I'm going to go ahead and check that box. And then the next one here is going to be a red coloration drop down. So we're able to set a color which will kind of mark our various orders for this particular auto spread. So again, we'll get to a point where we'll actually see this firsthand. So we'll just set that for red right now. Now, if we get down to line 2 here, we have a drop down, which is going to be the various pricing methods that we're able to use for our particular spread. We look at window here, there's basically 4 different pricing modes. So the first is price differential. Okay, so it's simply taking the price of leg A, subtracting the price of leg B to give us our spread price. So price of the first leg is 5, next one is 6, the spread is 1. Next one's going to be the ratio. So that's going to divide the price of leg A by the price of leg B. The next is going to be net change in ticks. So that takes the current net change value of each leg and then calculates a spread price using that differential. And then custom is going to actually let you fully customize and modify the mathematics behind it to whatever you see fit. So might be a little bit small on the screen there, but those are our 4 drop downs that we see here. Now, I'm going to circle back to this in just a moment. So what I'm going to do next is I'm going to actually drop down to the contract row. Gives us a little bit more color on those pricing methods in just a moment here. So if we go to contract, and like we said, we're looking for crude oil, CL, March 23, and we're going to trade this against the Brent, April 23. So what we do is click on select the contract, and we can click on our explore button here. And this is going to be CME, crude. I'm going to click on one of these products. I type CL, takes me right to it. And then I'm able to select that particular instrument. In the same way also for leg 2, we can click explore again. In this case, we're looking for ICE, future, and BRN. And I believe we said April 23. Okay, so now we've defined our 2 legs that we are going to be buying and selling using this, this particular auto spreader. Okay, now if we go back up a line here to, we have this kind of grayed out line that says, 1 times leg 1, merge price, etc. So this is the equation that is being used for this price differential. Now, as we toggle through these drop downs, we'll see that it modifies the mathematics on that pricing method. And you also notice that in our MD display on the right here, the synthetic market that we're generating, that modifies as well. So as we kind of tick through here, you'll notice also that it's always gray. So I'm clicking on there and I can't access it. Only when we get to custom that it actually allows us to go in there and we can modify and modify it to whatever we see fit. All right. For our example today, we're going to just leave it as price differential. So as we can see, if we're buying CL, selling Brent, then we are, our spread is about 690 or so. We'll mention, we have this reload checkbox here. So reload is a feature that we have which allows us to, maybe, in an example where we're, we have a product that is not so liquid, where the bid ask is only maybe a few contracts, and we need to buy 100. We may not want to broadcast that we want to buy 100, so we only want to do 1 at a time. Reload is similar to like an iceberg, where we'll only disclose 1 order at a time, even though we want to do 100. Again, we'll do a full example of this momentarily about how to place this and so forth. But we can actually build this into the configuration, which is the point here. So we check the box and we say we only ever want to disclose no more than 2. The offset allows us to say, when the next order goes in, do we want it to advance towards the market or off the market? That's for the auto spreader order itself. And then the delay is going to be, how much of a delay, if we want to buy 100 and we get filled on 2 and our spread is made, how long until we quote the next 2? Okay. So moving back down here, so we set the contracts already. And now if we look at the ratio is going to be the number of contracts that the auto spreader is going to look to place in these various instruments. So if we go back to the slides, we see that we've got these 2 contracts. They're fairly similar, right? So we're using a pretty straightforward example. In this case, the crude oil from CME, the CL contract on the left here, it's a 1,000-barrel contract. It's priced in dollars and cents. Minimum price fluctuation, 1 penny per barrel equals $10. Go to the right side, it's basically the same information. Now, if the Brent contract was 500 barrels, let's say, that would be half the size. Therefore, if we were to buy the CL contract, and we got filled on one, in order to properly hedge in a ratio sense, we would need to sell 2 Brent contracts in order to make the contract unit equivalent. So 1,000 CLs and then 2 times the 500 barrels in the Brent contract. So in this case, we're going to be leaving this +1, -1, again, given the similarities of the contract. We'll also be leaving the multiplier the same. The multiplier would be used for, in the case of, let's say, a minimum price fluctuation or a pricing unit is not equivalent. We can then use the the multiplier in order to modify our pricing so that we can say and we can quote the spread in a proper term. In this case, they are similar, so we're going to we'll leave these as is for the time being. Next is going to be pay up ticks. So why would we use a pay up tick in this case? So what it allows us to do is to specify an acceptable amount of slippage that we're willing to take on our hedge leg. Okay, so we'll be trying to achieve the spread at a particular price. However, if we are willing to accept some slippage in order to ensure that we get filled on our hedge leg, we would then increase this value in order to pay up and ensure that we get that fill with our hedge leg. So once the Autospreader has calculated the hedge leg price, it will adjust this price by the number of ticks that you have specified moving your hedge order further towards the opposite side of the market. We have in our notes here, positive values are going to pay towards the market, negative values are going to price your hedge away from the market. So be aware that it can go both positive and negative in this case. The next line is going to be active quoting. Now, active quoting, in this case, we're going to disable it on our second leg. In a moment, we're going to launch this and place some orders. And if we disable it on one leg, it makes it a little bit easier. If it's your first time seeing Autospreader and how this works, it's a little bit easier seeing a single quote order just to kind of understand how this is all working. And then we'll come back, we'll tweak this and add active quoting to both legs. But simply a checkbox that allows us to disable active quoting in a particular leg. Lean on indicative is going to be specific to certain exchanges that allow you to lean on prices during a pre-open or an auction market state. In this case, Brent and CL are very much open in trading, so we'll leave that for now. And then if we go to the next line, which is enable hedging, in this case, we do want to hedge on both legs. There's no reason not to, given our current example. So we will leave both of these on. There are examples where sometimes an instrument can be added in order to adjust pricing or introduce a currency difference in some of the spreads. In that case, you might not want to quote or hedge in that particular leg. It's more there just for the pricing mechanism. So in this case, we'll leave enable hedging enabled here. Okay, so from there, let's go ahead and I'm going to zoom out a little bit. Here we go. Okay, so from here, we're going to touch on more of this as we go along here, but at this point, we want to jump in and actually see some of these orders in action. So I'm going to go ahead and save this particular instrument that we created. All right, so now this shows up in our list. And again, we're back in our Autospreader window. This is the one from Widgets, Automation, Autospreader. And this is the spread that we just created. We just have a few things that we can do here. One is this first button, which is going to bring us back to our config, which we're already set there. The next is going to be the launch button. And we have all kinds of options here, but in this case, we're going to open with MD Trader and legs. So this is going to give us 3 things. On the left side, we have one MD Trader, which is going to be our synthetic market for our particular spread that we've just created. And then we have a CL March 23 leg, our first leg in the center. And then Brent April 23 on the right side here. Okay. Now, if we go back to our Autospreader MD Trader, this is where we're going to be placing orders and modifying and so forth. So any activity that we're really going to create new orders, modify, will be done over here. Now, right off the bat, we're going to go ahead and place an order. And we're going to put an order down here at 695, negative 695. And you'll notice that as soon as I place that order at negative 695, we get a single order that appears in our CL March 23 contract. All right. Now, it is important to note that this particular order is currently quoting at 74.80, and that is purely because Autospreader is watching both of these legs, and it knows that it can go into our Brent April 23 contract, and it can sell in the case that this quote order is filled at 74.79. Autospreader knows that it can go over to Brent April 23 over here and sell at 81.74. Okay, so Autospreader is putting this order in based on where it can find liquidity in the Brent April 23 contract. All right, so Autospreader will continue to watch, where the liquidity is based on how we define this spread, and it will requote this quote order based on that liquidity. Now, you'll notice that there's only a single quote order in the CL contract. If we go back to our spread that we configured, that is as expected, given our active quoting is disabled for the Brent 23 contract. So if we go back, we can, okay, let's reline this back up here, bear with me. So if we go back to our configuration, we can enable active quoting on both legs. We can save that change. Changes occur dynamically. I'm quoting 2 lots here. And if we go back and we now place an order at, let's say at 7 even, you'll notice that we now have 2 quote orders, one in the CL March 23 contract and one in the Brent April 23 contract. Now, these are specifically both quote orders. And in the same way as when we had a single order out here, these orders will quote based on where Autospreader can detect enough liquidity in the other leg to make the hedge order get filled based on the liquidity. And it will requote based on, that pricing information. Okay. All right. Oops. Over here. Okay. So a few other things that we want to touch on here. A moment ago, we looked at, within our config, we had set reloader and set a minimum disclosed quantity of 2. If we go back to our MD trader, I just want to point out a few differences here, specific to the Autospreader MD traders. So in this case, there's obviously a difference between the ASC order pane and the CL March 23 order pane. In this case, we have a 2, a 2, and a 2. 2 is going to be the repeat, or this bottom value here, really, is going to be a repeat quantity of what is the order quantity that we're next going to send or next looking to execute in the market. Now, since we have this reloader functionality enabled, RLD, this button here, enables, disables, what we're saying here is we want to trade 100 contracts, only disclosing 2. Again, similar to an iceberg order. So when we place this order, we'll see, I'm not sure if this is large enough on your screen, but it says W2, so working 2, U98, undisclosed 98. Okay. Again, when we look at the legs, the quote orders on both legs are only working 2 lots. So, working as expected. So we're not showing the full 100 lot and giving the market too much information that we don't need to give it. Okay. Also, while we're here, we have an SNP button as well, and this is the sniper functionality. So sniper functionality allows Autospreader to look at the market and say, instead of quoting an order and then, determining where the quote order needs to be based on the hedge, it simply looks at the market and says, do I have, the liquidity on both of these legs to achieve the spread at the quantity, at the price that I am looking for? If so, send both orders simultaneously and get the fill. If the order is, or if the liquidity is not present, then the order will take no, or Autospreader will take no action, and it will just hold on to that order and continue to listen to the market and look for that necessary liquidity. So if I hit sniper, we're going to do a 4 lot in this case. I can click one in at 695. No quote orders will appear in my CL or Brent legs, which is as expected. And if I were to drag and drop the order across the market, we would immediately be filled. As we can see, even from the synthetic market here in the ask, that there is plenty of liquidity at 91, 90, 89. So we'll go ahead and do that. Actually, let's reduce the size a bit. Place the order, drag and drop, and then we're immediately filled. So in that case, we got filled for a spread of 690. We see that we are now long 2 in the crude oil, in the CL March 23 contract, and we are short 2 in the Brent April 23. All right. Same way also, we can sell that same spread using Sniper and flatten our position. Okay. Okay, so if we go back to our configuration here, we left off on lean on indicative. The next one here is going to be convert quote to hedge. Now, convert quote to hedge is a necessary feature, as when we were placing simple orders here, we're quoting on both legs. Now, there is a situation in which a market dislocation can occur in both legs, where in this case, there can be a big sell-off in CL and a large buy order in Brent, in which case both of these orders get filled simultaneously. Okay. Now, these are both quote orders, which means that as soon as they are filled and Autospreader is aware of that fill, they are immediately going to send the hedge orders. Okay. So that means that if that dislocation occurs, both of these quote orders are filled, hedge orders will go in, which means that if we're trying to get long this spread with a 2 lot, all of a sudden we would have a 4 lot, therefore would be double filled. Okay. Now, what we can do, if we go back to our config, convert quote to hedge, if we were to click the drop down here, we would see we've got a few options here. So in this case, we could say we would like to attempt to use the quote order to hedge, always use the quote order to hedge, or always use the quote order to hedge and preserve Q position. So what this is saying is, instead of always sending that, that hedge order, first say, am I quoting something else already that facilitates this? Do I have an order in the market that is going to be able to facilitate this spread? If so, let's just move that order so we don't risk double fill, and then I can achieve that spread. So we can set one of those, save the change, and then in that case, the quote order on the Brent leg would simply move to the market and achieve the spread. Well, it would move to whatever price it needs to move to in order to achieve the spread. While we're here, I do want to note, actually, let's go back. We're going to cancel some orders here. And we do want to touch on another feature we have, which is going to be the hedge manager. So if we're going to go to our config here, we're going to look at active quoting. And on the Brent leg, we're going to uncheck active quoting, just to simplify our activity here. Now, if we go to widgets and we go to automation, we can go down to the hedge manager here. And what the hedge manager is going to do is going to list all of our orders, all of our hedge orders that have been placed on the accounts that are associated with our user. So anything that we can see that is a hedge order. Okay. Now, if we go back to our spread and we place an order, again, we're only looking to quote in a single order. And if we look at our CL leg, for the purposes of this, just kind of for the demonstration, I'm going to drag this order across, okay, and immediately get filled. And this is going to give us a hung leg in the Brent April 23 contract. All right. So as long as that's there, notice it's kind of denoted with this orange marker here. As long as that order is out there and unfilled, it is hung. And if we go to our hedge manager, we're going to see we have a single line here for it. And basic information, what is the algo, what is the exchange, the contract, etc. And we get a couple of options here in order to manage it. So we can cancel it, but again, that would not let us achieve our spread. And then we can see the quantity, the price, the ticks away, and the order quantity. We do have an MD trader button here, so in case we don't see which ladder this is on, we can bring this up, drag and drop the order in case there is a need to immediately get it filled. We can drag and drop, adjust the order as we see fit. And then also just from the hedge manager itself, we can click this pay up button in order to move the order one tick closer. We do it again, all the way towards the market, or we can click cross inside. That's going to move the order right across, get the fill, and achieve the spread. All right. Bring my config back up here. Okay. So again, working down our config here, just a few other things to note. So we have QHolder as well, which is, QHolder is, in a sense, it's a way to, well, as the name suggests, maintain a position in queue. So if you have this quote order that is constantly moving with the market, there we go. Let's get another one in there. So if this order is constantly moving around in the in the CL contract, that order is almost always going to be at the back of the queue, given the amount of motion that is taking place in the CL March 23 contract. So if you were to, in a quieter market, perhaps, you might want to put an order at every price level or a number of price levels in order to minimize some of that, some of that loss of queue position. So in this case, we'll take the QHolder orders. We'll set that value to 5. We'll go ahead and save. Now, when we go back, first note, we do have a QH button here, so QHolder. We'll do 2 lots again, disclosing 2s. And when we go into the book, we'll say we want to buy at $6.95. And what you'll see here is that, there's my config, here we go. So what you will see here is that we set the QHolder orders to 5. And now when we look at our CL March 23, we have this whole stack of 5 orders, which means that if the liquidity on leg 2, let's say the prices drop down a tick, our first order would roll to the back, and then the rest of the orders would remain in their position in queue. So this is not all 5 orders all clicking down. It's just the top one rolling to the bottom. And then if the prices go up in the second leg, they would then roll these orders higher, ideally towards the market, so that we can execute that order. Now, it is worth noting that these are very real orders. So if there's a large dislocation, they very much would be filled. Yield is the next line that we have in our config here. Obviously, that's interest rate related. In a later webinar, we are going to kind of delve into all things interest rate related and the whole interest rate complex. So we're going to leave that one for now. But we do want to touch on some of the rules that we have. And let's take a look at, back to our slides here. So we have certain rules that we can apply to our auto spreader so that we can kind of get some desired behavior in order to improve our experience and achieve the spreads as we see fit. So when we go to our config, last line here is going to be rules. We click on the plus sign. We'll see that there are a number of various rules that we have here. We're just going to touch on a few of them today. However, so actually first let's just do inside smart quote. Okay, when we add a rule, we get a line item here, and then we have a little plus. So we're able to hit that drop down, expand this a bit. And in this case, it's going to have all the variables, all the settings that we can set for this particular rule on that line. Inside Smart Quote, okay, so this is going to be a pre-quote rule. It's going to suppress changing the quote order if, moving toward the inside market and new order price is not sufficiently close to the inside market price. So this is going to reduce the amount of, clicking this of your order kind of bouncing around and moving, closer to the market based on a, more erratic type of market. As we continue to add these, we simply can hit the plus again. We can do liquidity base back. Yeah, there we go. Base backup again. We hit the drop down and we can see, what are the variables that we can set. Of course, checkboxes if we want to enable this or disable this for various legs. And in this case, if the market quantity at the calculated hedge price is greater than or equal to the quantity threshold that we're setting here, then the hedge would then back off 1 tick from the calculated hedge price. Okay. Again, there's a number of various rules here. Let's see your liquidity-based pay uptick. We'll do 2 more here. So the liquidity-based pay uptick, again, how much are we going to pay up if this quantity threshold is violated? So if the volume of the opposite side of the market at the price level, 1 tick from your working hedge price, dips below this quantity threshold of 250, then pay up 1 tick from the current hedge order price. And then we'll do 1 more, which was going to be time-based. So as the name suggests, here we go. Getting a lot here. So as the name suggests, simply time-based, go to market. So in this case, it's in milliseconds, so 5 seconds. So if the hedge order is lagged for more than the user-defined number of milliseconds, this rule changes the hedge order to cross the market, achieve that spread, just to get the hedge on so that you can get the spread complete. Now, when you've added these, we have this drop down. You can add them, edit, remove. You can move them up and down as well. So sometimes there's a priority issue that you want, various things to prioritize before others. And then, we only looked at 4 here, and there certainly are quite a few more. Our website at tradingtechnologies.com, we've got all kinds of documentation as well. If you click on support in the upper right, there is a link to the help library. And I'm pretty sure if you just type in, one of the names of the rules, it should take you right to where you need to be. Just going back to our slides here, all of these Autospreader orders are being deployed. When you place that order, it's being deployed to a server which is located at the exchange. Now, in our case, we were looking at CL versus Brent, so that's going to be a CME versus an ICE contract. So whichever product is in leg 1, that is the exchange that the Autospreader order is going to go and operate from. So in this case, CL is from CME. So this order would go and operate on the Autospreader server from the CME. Now, that is, a general server that we offer to, all the clients that are, TT Pro and using Autospreader. And we just wanted to note here that, these are the general times that we have for both quoting and hedge orders. Obviously, if there is a dedicated server that you have, that we're able to facilitate for you, obviously the times can be much improved there. So if that is something that you are looking to consider, certainly let us know, and we can certainly connect you with people that can facilitate that for you. So also in this case, we did a fairly straightforward example, right? The CL and the Brent, they're almost identical contracts, same price, same tick, same 1,000 barrels, right? In the future, we're going to do some more webinars. It's going to kind of delve into some of the more complex spreads, how you price them, how you work the multiple, how you work the ratio, and how you kind of get them to tick in a way that is beneficial and makes sense for the user. I would say that China crude is kind of a favorite these days. So if you were trading CL versus I think it's SC, at the INE exchange in China. That's certainly something that we're able to facilitate. So that takes a CME and an INE contract. And then I think we also add in an SGX contract in order to account for the currency change. So again, more complex, but the point is more that, you can pretty much achieve, if you have an idea, you can pretty much achieve whatever it is through a little bit of work and kind of sorting out that configuration. And but that we'll have to wait for next time. Amarita, on to you.
All right. Thanks very much, Mike, for that session. It's appreciated. We did have a couple of questions come in. So I'm going to give those questions to you right now. One of the questions was, can autospreaders be placed as GTCs and do they persist through the weekend?
Yes. So they can be placed as GTCs. Let's go back here. All right. So we go back to our MD trader for our specific auto spreader MD trader. We have these drop downs here. It's count, order type, and so forth. So if we go to our TIFF, we can, we've been placing all these orders today as day orders. So these would expire at the end of the trading session. However, let's get an order book up here. So if we place these orders, we click those in, and we'll see that our time in force, we can find it, there we go. Our time in force is always saying day. All we have to do is toggle this down to GTC, place another order, and we'll see that that has changed now to GTC. And sorry, persist through the weekend. Yes, I do believe so.
All right. So the second question was, does sharing the TT workspace include the Autospreader configurations and the ASE rules?
No. Sharing a workspace is just the workspace itself. The actual configurations and rules and so forth, there's a few things that you can do. So if we pull up the config, I did check a box here for share. This allows other users within my company. So my company is the company you work for most likely has multiple users. If you're trying to share it with them, by clicking this box, this will allow the other users to see the same spread when they pull up this Autospreader window. So whatever you create here, as long as you share it, they should be able to see it as well. It's denoted right here by visibility. So in this case, the one we created was shared. If you are trying to share it to someone outside of the company that you're in, I believe you can right-click. There we go. Right-click, export, selected spread, and see, click that. Downloads a little file, JSON file, and then you can, pass it along to them as you see fit.
Just one more question. Can TT order types be used with Autospreader?
The TT order types can be used with Autospreader, although it's fairly limited. So again, back to the Autospreader MD trader, we hit our order type dropdown. By default, these orders are always limit because we're trying to achieve a specific price. So we start with limit, and then we do have a few TT order types. In this case, just TT iceberg and TT timed. So they are available. However, there's TT iceberg is available. However, you do have reloader already, which, as we demonstrated, that's saying I want to buy 100, only showing 2. So in a sense, it's a little redundant. There is the TT timed algo as well.
There was actually another question that just came in. If we are working multiple orders, can we add labels to each order?
Not that I can think of offhand. So
thank you for the question. To whoever asked it, let us look into that, and we will come back to you. This question can be multifaceted. So let us put an answer together, and we will come back to you on the answer to this question. If anyone has any more questions, please feel free to send them in. Even if we don't cover it right now, we will cover it in an email and send it back to you. That being said, hopefully everyone here has gained a comprehensive understanding of Autospreader, its benefits, and its capabilities. As mentioned earlier in this webinar, this is the first one in a series of 3, giving all participants an opportunity to deepen their knowledge and improve their trading strategies. The next webinar will cover some of the advanced Autospreader configurations that Mike just covered, and we will also show practical examples and use cases of the spreads. The last webinar will cover the use of Autospreader with some of our more advanced TT tools, so like the aggregator and ADL. So we are going to gradually increase the level of complexity of these webinars. This was the more fundamental, what is Autospreader? And then we are going to go higher and higher from that. I believe another question just came in. So Mike, I am going to grab you for another one. Will adding the Autospreader rules slow down the firing speed?
No, I believe it's just in the processing of, I mean, it doesn't slow anything down. It's just adding to the logic of the spread itself.
And they're all working on the Autospreader engine. So it's all a part of what our Autospreader machine can do.
Right.
All right. I think those were the questions that we had. Thank you all very much for joining today's webinar. We look forward to seeing you on our next 2 webinars on Autospreader. Thanks very much.